According to the 2013 research report by Dalbar, the average equity stock investor over a 30-year period ending 2013 earned an annualized return of just 3.69%, while in comparison, the S&P 500 stock index returned 11.1% and actually had a slightly lower risk level. Wow, can you relate to this? Tune in to find out why most people are taking on stock market risk but only getting Treasury bill returns.
Welcome to this episode of Plan Your Wealth with Purpose, Principles for Investing and Wealth Creation, with Wealth Creation's education and tax coach, Jim Fisher. James Fisher is a registered advisor offering investment advice through Signature Investments, Inc., an SEC-registered investment advisor, Dayton, Ohio. James Fisher CPA and Wealth Creations is unaffiliated with Signature Investments, Inc.
Let me ask, are you confident you are following the 3 rules of investing? If you are experiencing returns similar to those in the Dalbar research, then chances are your returns are predicated on 4 myths that can be devastating to a portfolio. Let's expose those myths. Myth number 1, the myth of stock selection. Investment advisors can consistently and predictably add value through individual stock selection. Fact, in 2013, there were over 30,000 open funds. Since the beginning in 1923, a total of 54,000 funds have been developed. Therefore, almost 23,000 funds, or 40%, have since been killed off, mainly due to poor performance. In other words, poor stock selection. Myth number 2, track record investing. Finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. Truth. A manager's ability to pick stocks in the past has little to no correlation with his ability to do so consistently in the future. In other words, it's not necessarily skill, but dumb luck. Pull out a coin. What are the odds of flipping it on heads? 50%, correct? On the 10th flip, what are the odds of landing on heads? It is still 50%. This is mathematically true. But yet our brain wants to factor in the prior 9 tosses that have no relevance to the current coin toss. Myth number 3, money managers are able to utilize market timing to effectively predict up and down markets. Fact, research shows that over a 20-year period, if you screwed up and missed just 10 top performing days during that period, you would have accumulated about half of just staying fully invested. Charles D. Ellis, in his 1993 book, Investment Policy, Winning the Loser's Game, put it this way. The evidence on investment managers' success with market timing is impressive and overwhelmingly negative. And then there's myth number 4, cost of investing. What you don't see can't hurt you. Fact, there are many costs associated with investing that are not required to be disclosed. Active management of buying and selling stocks requires a bid-ask spread ranging from 0.04 to 1.34% of spread that is never disclosed. Mr. Ellis says, how much better must the active manager be to at least cover the cost of active management? The answer is daunting. To move forward, we must analyze where we are at. If you have found yourself doing these things and want to learn how to build a proper, prudent portfolio, then stay tuned to my channel or click on my website for more information.
Thank you for watching this episode of Plan Your Wealth with Purpose with Jim Fisher. For more information, visit wealth-creations.com. Also browse the other shows found right here at Toledo Biz TV Shows.